All right, so today we're going to talk about how to finance real estate investing. It's your real estate investor financing masterclass. We're going to go over all different loan strategies that you need to know when you want to invest in real estate. And of course, okay, there we go. So, one of the things that I hear a lot of times from people that want to invest in real estate is that they either don't think they have enough money for the down payment, they don't think that they're going to qualify because they write everything off on their tax returns, they're self-employed or, whatever. They don't have the income to qualify. They look at a property and they're like, oh my gosh, there's way too much work here. I just don't want to do it. I don't even know if I'll have the funds to be able to do that type of renovation. Or they'll find an awesome property and guess what? It's about to go into foreclosure and you need to close in a week. What do you do? So what I'm gonna show you today is how you can use all of these different financing strategies to keep more of your cash and keep buying more property. So that is what we're gonna cover today. What you're gonna learn today is why would you want to invest in real estate? Home equity lines of credit. We're gonna talk about the BRRRR method. Hard money loans. We're going to touch upon blanket loans. We're going to talk about where you find the money, fix and flip financing, DSCR loans, commercial, SBA, and most importantly, identifying which one of these loans is going to be the right strategy based on the property. And I'm going to show you all of that today. So, who am I? Why are you listening to me right now? My name is Danielle Damianov. I am with Nexa Lending. If you want to book a strategy call with me, my information is right there. My websites are there. And I am going to show my age right now. I have been in mortgage and real estate, mortgage since 2001. I started as a licensed loan officer with AmeriQuest Mortgage way back when. And then I read that book, Robert Kiyosaki's Rich Dad Poor Dad, and said, you know what? I really want to get into real estate investing in real estate. So I got my real estate broker's license. And I actually not only help people finance the deals, but I actually do the deals myself, right? We invest in real estate as well. So I can really help you identify which strategy is going to be the best. And I'm going to give you a full disclaimer right here, right now. You are not always going to make money on every single property that you invest in. So just keep that in mind when you're really looking at the different financing options. And we're going to talk about leverage. So my goal is not just to like give you a loan, right? My goal is to really help you identify what your long-term goals are, what your strategy is, so that way we can find the best financing strategies for you and for whatever particular property you are looking to buy. So you might be asking, well, why should I invest in real estate, right? And there's so many different reasons why people invest in real estate, but hopefully if you buy a property and hold it for a certain amount of time, or even buy a property and flip it, you should have equity and appreciation in there. If you buy a property that has rental income, right, then you can use your rental income to cover your monthly payments and get that appreciation and get that equity and also have cash flow. There's a lot of different tax advantages and strategies. And so real estate is really one of those few investments where you can use somebody else's money to purchase a property and somebody else's rent to pay for your monthly payment, right? You can't borrow money to go invest in a 401k. So you're using somebody else's money to basically help you build your real estate investment and retirement portfolio. So I want to talk to you guys about the market today because I can tell you that we are in one of the best markets except for 2008 and 2009. That was probably the best, right? But right now we are seeing foreclosures up. In the first half of 2026, they have increased by 21%. We are seeing tax liens up by 36% in 2025 and in 2026. And guess what? I'm not just talking about IRS tax liens. I'm also talking about tax lien certificates, people not paying their real estate taxes. We saw a 26% year over year increase in pre-foreclosures. A Liz pendants is the first thing that gets filed when somebody is not making their mortgage payments and the bank wants to start that foreclosure process. They file something that's called a Liz pendants. And so that has had a 26% year over year increase. Interest rates are up, right? So for a real estate investor, how is that good for you? Well, a lot of people are on the sidelines. A lot of people are renting. A lot of people don't want to buy a home right now. And so what that's doing is creating more rental opportunities for you. And it's also creating a supply and demand situation where when there's more supply, you're going to be able to negotiate better deals. And so I want you guys to think about something. A couple of years ago, COVID, we all know about COVID, right? I remember seeing what I saw back in 2005, and I thought to myself, our market is going to go down. And one thing I want to just point out real quickly is every single market is different. So when I talk about markets, I'm referencing the South Florida market. Okay. So if you are in Ohio, which I know Ray is, or if you are in, Massachusetts or California or whatever, your market might be different. Right. But we were seeing back during COVID, people lined up around the builders paying like 2% commission because they didn't need to pay a high commission to realtors because they had people lining up to buy a property. And I thought to myself at that time, I saw the same thing happen back in 2005. People lined up to buy these new construction homes. And now look at what's happening. Builders are they can't even give away the home, right? So if you are buying a property for $1 million and 2, 3, 4 years later, that same property, the builder's selling for 800,000, that is going to create a situation, especially if you have to move. And that's why we're starting to see those pre-foreclosures pop up, okay? Because people overpaid for homes after COVID or during COVID. So real estate investors, I want you to know you do not need a perfect market. Actually, a down market is the perfect opportunity for investors because most buyers, what they're going to do is they're waiting for rates to drop. They're waiting for prices to fall. They're waiting for the perfect market. And guess what they're doing? They're sitting on the sidelines while opportunities are passing them by. And this is the opportunity for you as a real estate investor because savvy real estate investors are going to focus on the deal and the payment, right? They're not going to just focus on the market or the interest rate. They're going to, in fact, what is that saying by Warren Buffett? It's like something along the lines of, I'm going to like draw a blank right now, but most people, yeah, when everybody's greedy, right, and everyone's buying, I was looking at that and I was like, you know what? I'm like, I'm not going to buy right now because I see what everybody else is doing. So you want to do the opposite of what everybody else is doing because you're going to then be able to negotiate when prices come down. You're going to have a lot more homes to choose from. You're going to be able to solve problems that other people can't. And then you can plan on refinancing once the conditions get better. So when there's fewer buyers to compete with, your negotiation leverage is going to increase, right? So cash is really a tool. And one thing I want you guys to think about also is a lot of times an investor will say, I have, let's just say $100,000. And I'm going to show you how you can get your $100,000 because you might be thinking, well, I don't have $100,000 right now. We're going to talk about that in a minute. But let's say you have $100,000 or $200,000 in cash, right? Investor A can go ahead and just take the $200,000, put it down on one property and be done with it. But investor B can take the $200,000 and then strategically spread that money across several different properties. That is going to give them much more appreciation, cash flow, and equity, as well as spread their risk across multiple assets. So the goal is not really to just buy one property with all of your money, right? It's to strategically come up with a plan to buy multiple investment opportunities. So let's talk about where you get the money, okay? Because that's a big issue sometimes when people are like, I just have no idea where I can even get the money if they do find a property. So the first is home equity lines of credit. If you currently own a home, okay, and you have equity in your home, and we're going to go through these together. So I'm going to show you how it works. But you can take the equity out of your current home, or if you have an investment property, you can take the money out of that investment property with a line of credit to be used for purchasing other properties. 401k loans. Now, if you're buying a primary residence, okay, most 401ks will allow you to borrow against the 401k. Okay, so you definitely need to talk to that, whoever your 401k is. If it's with Fidelity, you need to give them a call and see if that's something you can do. The other thing that you can do, and you have to be very careful with this because I had a lady do it. It was not under my recommendation. It is not something I would have ever recommended to her, but her financial advisor recommended this to her. If you have an IRA or a 401k or whatever, and you want to check with them, a lot of times you can take the money out as long as you put it back within 60 days. You will not pay a penalty. Okay. So if you do have 401ks, you want to call them up and talk to them about what the different options are to use the money without paying a penalty, right? So that would be your goal. You don't want to just use your 401k money. The second is hard money and private money. We're going to talk about that in just a little bit. Obviously, your savings, if you have a savings account, maybe you find an amazing property and you want to go into that. You don't have the money, but you'll know somebody that does. You can do a joint venture or partner up with them and say, hey, I'm going to do sweat equity in the deal. If you'll put the money, I'll do all the work. We can share it 50-50, for example. You can also get gift funds on most of these programs. So if you have a rich relative that wants to give you some money, right, for buying these properties, or if you want the seller to help contribute to closing costs. Now, if a seller is going to help contribute to closing costs, a lot of times there will be a max on what they can contribute. So let's just say it's 4% or 3% or whatever. So you'll definitely want to check with your lender or me on the seller financing. But that is a great way to get your closing costs covered, whether you're buying an investment property or an actual, primary residence. So let's talk about the HELOC. And I want you guys, if you have questions, to put it in the chat, and I will be double checking the chat just to make sure I answer everything for everyone. And we can do a Q&A at the end. So the HELOC strategy, okay? This is going to be for your home equity line of credit, like on your personal home, second home, or investment property. I can tell you we have not one, several of the best home equity lines of credit out there available to you. I had somebody apply and do the notary, not somebody, actually several people apply online, sign with the mobile notary in the same day. 3 days later, because there's a 3-day rescission period if it's a primary, 3 days later, they got their funds wired into their bank account. Okay. We do not need an appraisal up to $400,000. We do not need your income documents. Everything is done online. It is one of the easiest ways to take out money if you have a current primary residence or investment properties that have equity. And I'm going to show you how to check to see how much you could take out of your home. Okay. So what can you use the money for? Just think of a home equity line of credit, like a credit card on your house, on the equity that's in your house, right? You can use it when you want. You can pay it back when you want. So it's basically like a revolving line of credit, just using the equity in your home. You can use it for whatever you want. There's absolutely, it's like cash. There's absolutely nothing that you can't use it for. So renovation financing, closing costs, down payment on the property. So even if you don't want, like you're looking at properties now and you're going to buy a property in the next couple of months, you can get the funds now and wait so that you have it and you're ready when you buy that next property. Okay, so let's look at this HELOC strategy. This is how you guys need to kind of do the math on your own, or call me and I can help you with it, to see how much, if you do have equity, and how much you can borrow. So let's just say you have a $700,000 home and you have an existing mortgage on your home for $350,000, right? So now you have $350,000 in equity on your home. Most home equity lines of credit, and it's going to depend on your credit score and a couple of other things, but let's just use an 85% loan to value example. Most home equity lines of credit are going to go to an 85% combined loan to value, meaning your first mortgage and the home equity line of credit. So if we use this $700,000 home value example, I'm going to show you real quick here. If you look at the math, that means if I take $700,000 and I minus out my $350,000 existing mortgage, it leaves me with $595,000. Okay. Or I'm sorry, 700,000 times 85% is 595. So $595,000 is the maximum that my two loans together can equal. Okay. So if I then take that 595 and I minus 350,000, that's my first mortgage, then the maximum home equity line of credit estimate that I can take out would be $245,000. So what you need to do is take your home value times 85%, it will give you a figure, minus out your current mortgage, and whatever is left over is technically what you'll be able to take out for that home equity line of credit. Now, there will be some closing costs and things like that. So I'm just using that as an estimate. But from start to finish, you literally can have your money in as little as 5 days. Use the money for whatever you want. If you do want to apply for that HELOC, you can go to equitytaponline.com. That is my HELOC website, and I have all of the information on there about our HELOCs. And we do go down to a 600 credit score, right? So home equity line of credit is key. The all-in-one loan, I am not going to get into this right now. And as Ray, who is on here, knows, this loan, he has it, I have it. This loan can be tricky to explain. So if you go to YouTube and type in Danielle Damianov all-in-one loan, you will see all of the information on how the all-in-one loan works. I personally have this on my home, okay? So basically, it is a first mortgage home equity line of credit combined with a sweep checking account. I don't want to get into this because we've got a lot of stuff to cover today, but I encourage you, if you are interested in finding out more about this loan, and I have on the left-hand side here a little bit about like how it works. I really encourage you to go to YouTube and put in Danielle Damianov all-in-one loan. And as Ray is saying, he has it on an investment property and it's very handy. So yes, this is another great product when it comes to home equity lines of credit. The difference is that this is a first mortgage home equity line of credit combined with a checking account. Okay. I keep hitting the wrong button here and it's not working. Okay, so let's talk about fix and flip financing. This is the reason I moved to Nexa Lending back in, I think it was 2024. So in Southwest Florida, we had Hurricane Ian. Hurricane Ian came through and it destroyed our entire area, like the beaches, like everything, Sanibel Island. And so we have homes still that are sitting like this. If you are a local real estate agent in Southwest Florida, you need to listen up here because here's what is happening. A lot of people don't realize that you can finance homes like this. So real estate agents, what they're doing is they're listing these properties and they're listing them as cash only. And that's really limiting the buyer pool because who has $200,000-$300,000 to throw down on a property? Not a lot of, and then pay for all of the renovations, right? Not a lot of people. So this is a great opportunity for anybody to get into a fix and flip loan. And I'm going to show you exactly how it worked. So after Hurricane Ian, what happened was I had so many clients that lost their homes or their homes were damaged. And I had so many investors that wanted to purchase these properties. And guess what? The previous company that I was with, which was a retail lender, did not have this product. In fact, it didn't have any of these products that I'm showing you today. Or if it did, it was very limited on the options of what we could do. So our rates were super high. We were not competitive, whatever. That is why I moved to Nexa because we have over 300 lenders and a million different, lenders that we can basically finance any type of deal. And I needed that. I needed that for my clients. I needed that for my real estate investors. And I needed that for me because I was a struggling loan officer. I'm like, crap, all of the homes in the area are like destroyed. So fix and flip financing is amazing. This is what you do. This is the financing type when you see properties like this. And we can look at the home on the right. I purchased this one yesterday. Yes, that is the inside. And on the left, it was me closing. And I do want to give a shout out to April Ritchie with First American Title. because she was able to get this done for us in literally just over 7 days. We had to close this one super quick. So yes, I did not go into that home. I was about to go into the home and take videos for promoting this webinar. And when I saw the front door, I was like, okay, I can't step inside of this. So anyways, the clean out crew is going to have fun with this one. But these are the different types of properties that you're going to find with a fix and flip loan. And if you're a real estate agent, right, I want you to think about the opportunity that you have when you see these properties expire on the MLS, because it's going to happen. Okay. And I'll talk about that in a minute. But anyways, what is a fix and flip loan? This is a short-term bridge loan that is either 12 to 24 months. Okay. And let's say you need to go over, there is extensions. They are expensive. Well, not super expensive, but there are extensions, but they're short-term bridge loans. Okay. It is allowing you to purchase a property that looks like that with very little down. Okay. We can close in as little as 2 weeks if we really need to. 3 is better, but 2 is, going to be best. They fund 100% of the renovation costs. You're going to close in an LLC. If you do not have an LLC, do not worry, because I can show you how to get an LLC in literally like 10 minutes. And you have to have an exit strategy. So this is when you need to say, okay, I'm either going to buy this property and flip it, or I'm going to buy this property and I am going to refinance it into a DSCR loan, which we're going to talk about in a second. Okay. So there's 2 types of loans when it comes to fix and flip. There's your experienced investor and there's your inexperienced investor. Your experienced investor typically is somebody that has completed 3 flips within the past 24 months. Now, a flip can be buy, fix, and flip, sell, or buy, fix, and rent. Now, you might be saying to yourself, well, I do have 3 properties, but I didn't technically flip, like they weren't destroyed, right? So we can work with that. That's where the creative financing and strategy comes into play. But if you're an experienced investor, you're looking at 90% loan to cost. If you're an inexperienced investor, you're looking at an 85% loan to cost. So it's really not that much of a difference. You're looking at 75% ARV. I'm going to explain this in a minute. 12 to 24 months term. We can go down to a 640 credit score, but that will lower your loan to value. And also the interest rates are going to be a little bit higher. And then you're going to close in an LLC. They require you to close in an LLC on these types of loans. But the exact guidelines, the leverage, the loan to value, all of that, the experience is going to change lender to lender. So I want to show you guys the difference here between an experienced investor and an inexperienced investor. And then I'm going to show you some real numbers so that way you can see exactly how it works. So if you're an experienced investor, it's 90% loan to cost. When I say loan to cost, I know it sounds confusing. It's basically off the purchase price, the cost of the property. 85% loan to cost is going to be for an inexperienced investor. The maximum after repair value, this is very, very important, is 75%. This is why you want to work, and I will show you the numbers in a second, so I don't want you to get confused. But this is why you want to work with a local real estate agent. Because when you're looking at the after repair value, so what that means is if I'm buying a property for $200,000 and I'm going to put $80,000 in it, how much is that property going to appraise for once it's completed? Okay, so the after repair value. Experience requirements, 3 flips in 2 years. If you don't have that, you're inexperienced, is basically what they look at. No income documentation is required, okay? They don't even really look at assets. This is all based on the property and the experience that you have and your credit score. Those are the 3 main things. And then also the way that the LLC and operating agreement is, is formed. But those are the 3 things that they're looking at. We can go down to a 640. A 660 is better. You need an exit strategy. What are you going to do? Are you going to sell it or refinance it? And you really don't need, you do, obviously you need the money for the down payment and the closing costs, but most lenders don't even look to see like where the money came from. Okay. They don't look for your assets. They really just care about the property. So I want to talk about the fix and flip, real quick when it comes to the budget and when it comes to the after repair value. So let's use these numbers based on a $200,000 purchase price. Okay. So let's just say, and I will tell you, so let's just say the property is 200,000. Okay. You're an experienced investor. You're going to put 10% down, which is $20,000. I'm sorry, 40,000. No, yeah, 10%. Sorry, 20,000. Sorry. Okay. The loan amount's 180, right? So your loan to cost is 90%. Your loan amount is 180. It's going to cost you $75,000 to renovate the property. They want to control the renovation. They pay it out in draws. So when you get the home and you close on the property and you have $75,000 renovation budget, you have to start making those payments. Like you have to start the renovation, right? And let's just say it's gonna take like 4 draws basically to complete the renovation. You have to start that renovation and then show them what you've done. Once you've shown them what you've done, they're going to go ahead and give you money. Let's just say the first draw is $15,000 because you got the dumpster, you got the clean out, the flooring, the da 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 da. So that's how it works. But they will finance 100% of that project. That is so important because all you're doing is putting 10% down at this point and you're getting 100% financing for the renovations also. Okay. So when they're underwriting the deal, what they look at is what is the purchase price? You have to get the budget and show everything you're going to do. Line item, paint, flooring, dumpster, permitting, whatever, right? On the line items. So then it's going to come up with the total project. So they need to agree with your budget. They will send not an appraiser to the property, but basically somebody that's going to look at the property, that's going to look at the budget, that's going to make sure it's within budget, right? And then also look at that after repair value. How much is it going to be worth after everything is completed? So if we look at this here, if we have a $200,000 purchase price, a loan amount of 180, you put 20,000 down. We have our renovation cost of 75. Our total project is now $255,000 and our after repair value is 400,000. That gives us a 64% ARV. Okay? So that if we are like our budget's much higher or whatever, right? The maximum ARV we can go is 340,000 after repair value to be within that 75%. So the numbers I'm showing you are on an actual real investment property. The after repair value really is $400,000. But let's just say that the after repair value comes in at 320, right? It's not 400, it's not 340, it's 320. Then what? Right? So that's when we have to go back and either analyze the deal again. Is this really a good deal? Or can I fix the budget? Can the $75,000 get lower, right? Maybe we're not doing the fancy kitchen like we thought, or, whatever. Or I can put more down on my loan amount. So instead of just putting down the 10%, I can put more down. This is when it comes to strategy. I had a guy in Massachusetts that was basically looking to like double his property, and he was not allowed to do it because it was looked at like a construction loan. So we had to get in there and rework the budget and rework all the numbers to make it work with the total renovation cost in the ARV so that he could actually get the financing for it. So hopefully this isn't too confusing. Will you have to show receipts or market rate to what it usually takes to repair? How strict are they with showing proof? No, you don't have to show the receipts. You basically have to, and actually, if Stefan is still on, he can chime in because he deals with all of the draws with the lenders and stuff like that. We use these loans a lot. They're not strict. In fact, what some people will do if they have the funds, They might just do it all if like there's supposed to be 4 draws on the project. And when I talk about draws, what that is you're separating, and I don't want to get too in the weeds here, but like if it's $75,000, and your first draw is at 20, your second draw is at 40, your third draw is at 60, and your fourth draw is the remaining, right? You just have to show them what you've done so far, and then they'll send you the money for it. So you got to do the work, and then they're going to send you the money for doing the work. Okay. Now the interest is paid interest only, and it's paid on the draws. So I ran the interest rate number yesterday for a particular deal. It was for this scenario that I'm showing you right now, it was 9.75. Keep in mind, these are more hard money type loans. The rates are going to be higher, but it's an interest only payment and it's paid on what you've borrowed so far. So for example, if you have your 180 loan and your $75,000 renovation budget, your total loan at the end is going to be 255, but in the beginning you've only used 180,000. So if you take that 180,000 times the interest rate, and I put the wrong number at the bottom here, but times 9.75, that means your monthly payment is 1462 starting out. Right? So think about it. You're borrowing 180,000 plus 75 and you're only paying 1462 a month. Now, after you get that first draw and your loan amount goes from 180 to 200,000, now you're paying that 9.75 on the 200. Okay. I don't want to like confuse everybody here because some people are on just to like learn about the loan. So I don't want to get too much into the financing. If you look on the bottom right, I did put how to calculate an interest only payment. It is the easiest thing to calculate. It's your loan amount times the interest rate divided by 12, and that will give you your monthly payment. So if your loan goes to 200, or you want to see what it would be at 255 at, towards the end, because maybe it's going to take a couple months to sell, take the 255 times that 9.75 divided by 12, and you'll see what your monthly payment would be. Okay. So now we're going to talk about the BRRRR method, because after your fix and flip, if that's what you want to do, then what are you going to do? Are you going to flip it, or are you going to do the BRRRR method, which is buy a distressed property? You're then going to rehab the property. You're then going to rent the property out. You're then going to refinance the property, and maybe you even take some cash out, and then you're going to repeat. Okay. So you're going to buy, rehab, rent, refi, and repeat. That is all the BRRRR method is. Okay. So buy the renovation, buy the property that needs renovation. Obviously, the lowest you can get, the better. One thing I want to tell you guys, because I want to be 100% upfront with everybody. We had some fix and flip properties right after the hurricane. And when we looked at the ARV was, let's just say a certain amount. Let's just say it was 380, right? But by the time, we didn't realize we were entering into a declining market. And by the time it was now ready to sell the home, the values dropped. So our profits dropped. So you want to make sure that you're really understanding the big picture on where the market is going. As Wayne Gretzky says, I keep putting in all of these like little sayings here, but you want to skate to where the puck is going, not where it's at right now, right? So you want to be always looking for the future, not where the market is right now. So if we're in a declining market, and I just said this to my husband the other day, we want to take 10% off of what we think the value is going to be 4 to 6 months from now, 4 to 6 months from now. Our market is volatile. We don't know what's going on. Interest rates are going up. You know what I mean? So it might be a longer holding period. So where we think the market will be in 6 months, I want to take 10% off. So we're not like, oh crap, we're losing money, right? So that is just one thing to kind of keep in mind. And working with a good local real estate agent is extremely key. If you don't have one, message me. It won't be me, but I will pair you with a good one. So anyways, fix and flip and bridge loans, then you're going to stabilize the rent. You're going to get it rented out. And then we're going to refinance into a DSCR loan, and then you're going to repeat the process. And that is that BRRRR strategy. So let's talk about DSCR loans right now. I know these are hot, hot, hot. And I want to talk to you about how you qualify for them. And I will tell you the interest rates right now on them are amazing. Okay. They're actually, believe it or not, the same or better than conventional loans on primary residences. And I'm not just saying that because I just priced a primary 20% down and I priced a DSCR 20% down, and they're about the same. The only difference is the prepayment penalty. So no income documents are required on this loan. We do not need W-2s. We do not need tax returns. Minimum 640 credit score. Some lenders might go lower. I mean, I try and tell my investors a 660 because really at the end of the day, you're going to get better pricing, better terms, the higher credit score that you have. The down payment starts around 15%. I tell my investors 20, right? You can do a 15% down payment, but you're going to get much better options, much better pricing with that 20% down payment. You can close it in an LLC or you can close it in your own name, whichever you prefer. Obviously, an LLC is going to protect you, better if you close it in an LLC. Plus, I'm not a CPA, but you might have better tax write-offs for that. And then you can do a short-term Airbnb or a long-term rental. And I'm going to cover this in a minute because this is the key to this loan. This is the most important piece of the loan, and I'll explain it in just a second, okay? And then you can do this on a purchase or on a refinance. So you can do a rate and term, you can do a cash out refinance. So I want to talk about DSCR and talk about the ratios. So a DSCR loan stands for debt service coverage ratio, okay? Debt service coverage ratio. What they are looking for is just rule of thumb. Let's just say your total monthly mortgage payment is $2,500. Well, then that rental income, what the market rent is for the property equals 2,500. We are now at a 1-0 ratio. Okay. So the mortgage, and when I say mortgage, it is principal, interest, taxes, insurance, and association dues. Even though if you're in an HOA and your association dues are paid to the association, that is still part of your mortgage payment. Even if you decide to not escrow your taxes and insurance and you want to pay them separately, that is still in your monthly payment, right? So we're taking PITIA, principal, interest, taxes, insurance, and association dues. All of those that rent has to cover. If we have a 1-0 ratio or higher, you will get the best deals. You will have every lender of option available. When that ratio goes under 1, so your PITIA payment is $2,500, but it's only going to rent for $2,000. Okay, well, now we have a problem because the ratio is under 1, and so not every lender wants that. You're going to have to put more of a down payment. It's a riskier type of loan. And keep in mind, they're not checking your tax returns. They're not checking your income. So it's very important to look at that ratio. This is where, and whenever I have a DSCR loan, I get with the realtor and I let them know, look, we need to make sure that we are within this ratio. And sometimes it takes a little bit of trying to figure out exactly where you're going to be. Now, if you do a short-term rental, let me see if this is on the next page, actually. If you do a short-term rental, your long-term rental interest rates are better. Your short-term rental is going to give you more rent, right? It's going to probably keep you within that 1-0 ratio, but your interest rates are going to be a little bit higher. You may have to put more down. So lenders really like to see the long-term rents when we're looking at that ratio. Okay. So let's look at an actual example. Let's say we have a purchase price, and I'm actually doing this loan right now. So let's just say we have a purchase price of $415,000. They're going to put down 20%, 83,000. That doesn't include closing costs, guys. So keep in mind, every time we're talking about down payment, that is not including your closing costs. And on investment properties, they are higher than a traditional mortgage, okay, conventional loan. Your loan amount is $332,000. So I have a deal right now, same thing we're talking about, same scenario. 7.25 is the interest rate with a 2-year prepayment penalty. Okay. That means his principal and interest is at 2264. His taxes, insurance, association dues are 597. His total monthly payment's going to come in at 2861 and the monthly rent is 3,000. We're perfect. We're good. Now, how do we find out what the property is going to rent for? DSCR and LLC or trust, is it no longer on your personal credit? Okay, Kai, great question. So she asked if they close in an LLC or in a trust, is it not on your personal credit? And the answer is yes for most lenders. You still are a personal guarantor on that loan. So even though you're the personal guarantor, if you close in an LLC, I'm not sure about the trust, but I do know 100% an LLC, it will not go on your personal credit. For most lenders, we just have to, if we're going with a one-off lender, we would need to just double check if that's something that's important. But that's a great point because your credit score, if you have 5 of these DSCR loans and they're all on your credit, you're probably going to be looking at a lower credit score, right? So not having these loans on your personal credit is also a huge benefit of closing in the LLC. So I'm really happy you brought that up. That's awesome. So how do we figure out what the property is rented for? Well, if it's currently rented, we use that rent. If it's not currently rented, then we're getting an appraisal and we're asking the appraiser to do a market rent schedule. What they do is they do it just like an appraisal, but they do it on the rent. So they look and see, okay, what's going on with rentals in this area? What have similar homes rented for? Okay, so, and then they'll give us the market rent schedule. We do need to get creative sometimes. This deal that you're looking at right now, I've actually just moved to another lender because we were able to get the interest rate lower and I was able to go with a long-term rent because we don't know where the rent is going to come in. So if it comes in under, I might be, having to like strategize on how to fix this so that I can get him the best interest rate, right? So this loan does have a 2-year prepayment penalty, but to be honest with you, at 7.25, who cares, right? He would be in the 8s if he didn't have a prepay. So adding a 2-year prepayment penalty to these types of loans, you don't do them on conventional, but on the investment property loans, is definitely going to help get those interest rates down. So it's really important that you're doing the research on what that property is going to rent for, because these loans are based not on your income. It's based on the actual property. And that's for all of these investment properties that we're talking about. Okay. So if we have a 300,000 purchase price and a 20% down payment, loan amount of 240, and the market rent is 2,500, the housing expense is 2,350. We're now over the 1:0 ratio. So we're going to have even more financing options when you're over that 1.0 ratio. So who's going to consider these DSCR loans? Any buyer that wants to buy an investment property, right? And does not want to use all their tax returns. Now, you might be thinking, well, Danielle, I make really good income and, should I just go with a conventional investment property loan? The answer is, I don't know. Like a lot of times the interest rate is not going to be any better. So why deal with all of that paperwork? Why not just go easy route, hit the easy button here, right? And go the easy way. And we have so many options at Nexa with the DSCR lenders. I mean, there's probably 30 or 40, right? So that is the other thing. We have so many lenders to choose from that we really can. I pivoted yesterday. I was going with a specific lender on this DSCR loan, and I was racking my brain because I'm like, that rent is not coming in over $3,000. With me also being a realtor and access to the MLS, I can go behind the realtors or work with the realtor. And, actually the realtor and I were really working on trying to figure out what it's going to rent for. So we're not 100% sure. So I switched lenders to get him that lower rate to make it ratio. Okay. So Anyways, DSCR loans, self-employed investors that are writing every single thing off on their taxes. If you want to buy multiple rental properties, LLC, you want to close it in an LLC, and like Kai was saying, not have it on your personal credit. If you want to do short-term rental, so on the short-term rental, that is also what they're doing when we order an appraisal, we're doing a market rent schedule. Now, if you want to do your due diligence ahead of time, you can get something like AirDNA. Okay. AirDNA is basically like the Zillow for rental properties. So it will give you that rental property, like how much it should make on an annual basis based off of the going short-term rentals in that area. So that is AirDNA is like the Zillow for Airbnb properties. Okay. So we're not using so let me tell you what you need on the DSCR loans. Let me see if this is on the next slide. No. Okay. So on the DSCR loans, we are needing credit. We need you to list all of your properties. We need your driver's license, and we need 2-month bank statements to show, because fix and flip, they don't really care about where the money's coming from. On the DSCR loan, they do. So we need to show the 2-month bank statements, where the money is coming from for the down payment, the closing costs, and reserves. They don't want to see that you've taken everything out of your checking account and you have zero money left after closing. So a lot of times we need, like, let's just say 6 months reserves. Well, what is 6 months reserves? 6 months times the monthly mortgage payment. Okay. That's what reserves would be. So that's just an estimate. I'm just kind of telling you guys how to look at this stuff. So let's talk about hard money, right? When would you need hard money? There's a lot of different times that you would need hard money. Hard money is basically, and I have hard money lenders, and I also have private investors, like private lenders. So I had a guy that was going into foreclosure, not on his first mortgage, but on his second. He needed a hard money. A buyer wanted to buy the property. The bank wasn't waiting. If they did not come up with the money by the foreclosure sale date, then it was over, right? So a hard money lender is someone that's going to get you the money and the cash to close in like literally like that day if needed, or within a week or within 2 weeks. So it's somebody that has the money, that will offer a fast closing, that will give you the cash. A lot of times they're going to put a lien on the property. These are expensive. They're usually 3 to 5%, 3 to 5% or 3 to 5 points up front plus 1% a month. Okay. So these types of loans are expensive. They are not, but they're there for you to, acquire property quickly. Maybe something's going to auction, right? And you need to get that property. I had a lady call me, and this was not even a deal that I was doing, but I was able to get her the financing through a private investor. And she had $100,000 in escrow and had to close on a property that day in the afternoon, and her financing fell through last minute. So she was about to lose $100,000 because that once it's in escrow and your money goes hard, that's it. It's going to the seller, right? So I was able to get that money for her, but it was 5 points at closing. So 5%, I think she needed like $500,000 or something like that. I can't remember. And then it was 1% a month until she paid it off. So these loans are available, and they are going to help you compete with cash buyers. If you're buying, REO, if you're buying foreclosures, if, someone needs to, if you're dealing with probate or whatever, and you need the cash, you need to close extremely quick. These are an option, a very expensive option, but they're an option. So they can solve a lot of problems, but you need an exit strategy. They're typically 12-month terms. It's going to be a bridge loan, and you need to make sure that when you're analyzing deals, that you're looking at how many points am I paying? How much am I paying per month? Like, you're looking at all of the numbers, because the deal might look good, but if the financing is too expensive, then your profit might not be there, right? So you really want to make sure that you're looking at the entire picture. So 5 units equals commercial financing. commercial financing is different. Even though we were just talking about loans that are technically classified commercial, I want you to remember the minute the door goes over four, it turns into commercial lending, which is a different ballgame. Okay. Your closing costs are higher than expected. Your appraisal fees are higher than expected. They can be a couple $1,000s. They're going to do an environmental on the property, which is also a couple $1,000s. They're really looking at the deal. They're really looking at the property. They're not looking at your financials, okay? They're really looking at like the net operating income on the property. Does it cash flow? What is that debt service coverage ratio? What is the value in the condition? What is the experience of the borrower? Have they ever, purchased a commercial property? What type of commercial property is it? Is it a fiveplex, a 10plex? Is it, retail on the bottom, 10 units on the top? Is it a warehouse? What is it? Okay. So the moment the doors go over four, it is a different ball game. It is commercial. It is more expensive. We have not as many lenders that we do on the other loans that we were just talking about, right? So they are available. They are out there. And they also like large loan amounts. Yes, Jeffrey, who is on this call, also found that out. He found that out that it is a lot more expensive and it requires a higher down payment. Now, one of the things that we need to keep in mind once we're looking at these multifamily properties is that, or not multifamily, 5+ units, is that most of these commercial lenders want to see a minimum loan size of $500,000. They don't like seeing 100,000, 200,000, and those properties are out there, right? But they don't, that's not really like, they don't want to finance. So it becomes very limited on the financing and what financing options we have once we get into commercial. So yes, we do have commercial lending. You can see here, here's a fiveplex, right? We can do it, but the moment the doors go over four, it's a different ballgame. So the next couple of loans I'm just going to brush upon. We do have SBA loans. I'm doing an SBA loan right now for a guy that is buying a warehouse for his business. It is an owner occupied. He is going to operate his business out of this warehouse, right? So we do have SBA loans. We have SBA 7A and SBA 504. So I'm not going to get too deep into this, but just know that if you're looking to buy a warehouse or you're looking to buy some sort of commercial property or you're looking to buy a restaurant or a coffee shop or whatever, we can do those with SBA, okay? Let's see. Blanket loans, going to touch upon that. We do have blanket loans. I had a guy, an investor that's worked with me on several deals. In fact, I think he has the all-in-one loan also, but now he's looking into a blanket loan where he has 7 properties and wants to put one loan on all of these properties. So once you start getting into real estate investing, right, and you start building your portfolio, well, then it might be easier and make more sense to get a blanket loan. The interest rates were a little bit higher, right? But instead of paying 6%, well, let me take that back. Not 6%. We're not in that. It's not 2022 anymore. But let's say 7.5% here, and maybe you got 9 over here because you did a DSCR loan 2 years ago. They were in the 9s, right? So you can do a blanket loan and have one loan for all of your properties. So we can do those. I don't know why I keep having issues with this. Okay. So can your retirement money buy and fund your real estate? There is something called self-directed IRAs. Now, I don't want to get too much into it. What I think I'm going to do is a whole real estate investment series. I'm going to bring somebody on to talk about self-directed IRAs and 1031 exchanges and stuff like that. So I will be having a series. I will be inviting you guys to it. So that way we can really dive into these things a little bit more. I'm not a financial advisor, so I don't want to, talk too much about self-directed IRAs because I really don't know. But what I do know is this is an IRA that allows you to buy real estate, buy properties within your self-directed IRA, buy and sell. within those properties. Okay. You cannot do that in a traditional 401k. You can not do that in a traditional IRA. You can only do that with a self-directed IRA. If you are looking at what we talked about earlier, your IRAs, your 401ks, your retirement accounts, and they're not self-directed, those are not going to allow you to do it. You take that money out, it's gone, penalty, tax, you're going to get taxed on it as income. Like there's a lot of different things with that, right? So if you want to use your IRA money, maybe you talk to somebody about converting your IRA or 401k into a self-directed IRA, if that's what you're planning to do with your IRAs. So I'm not going to get too much into it, but what I will tell you is that I have had people, I just had two people actually, get denied by getting a mortgage because I did not know that they were trying to refinance properties in a self-directed IRA. Guess what? You can't do that. You cannot refinance a property in a self-directed IRA unless it's a non-recourse loan. What does non-recourse mean? It means no personal guarantee. Okay. So that means that they're not guaranteeing the loan. So when Kai asked about does a property, if you close in an LLC, go on your personal credit? I said no, but you are still personally guaranteeing that loan. If you do not make payments on it, they are coming after you personally, not your LLC, you personally for foreclosure. Okay. If you are in a self-directed IRA and you get a non-recourse loan, and that loan goes into foreclosure, right? You're not the personal guarantor on it. So I just had two people come to me to refinance their property. And one was a home equity line of credit. The other one was a cash out refinance. And they got denied because when they saw the LLC operating agreement and they saw the details that the property was in a self-directed IRA, they're like, we can't do this loan. So we do have options for non-recourse loans. The interest rate and the points are high. So whenever things are a little bit riskier or they're more complicated, right? You're going to have a higher interest rate and you're going to have more points. So let's do a recap here on what loan should I be using for what, right? So if you're looking to, you have equity in your home or you have equity in your investment property, you can take money out with a home equity line of credit or the all-in-one loan, okay? If you go to equitytaponline.com, that has all of the information as well as a link to the application to apply online. I have had people apply. First of all, when you apply for a HELOC, it is a soft pull. It is not a hard pull. So if you want to see what you would possibly get, you can apply. If you get denied, do not worry because I have a lot of other lenders. I had somebody apply on my equitytaponline.com and they owned the property in an LLC. It was an investment property. Well, this particular lender that's on my website doesn't allow for that, but I had another lender that does. So that it wasn't a big deal. There was no hard pull to their credit. It was only a soft pull. They got denied with that HELOC, but I took them somewhere else and they're approved for $334,000 on a home equity line of credit. So if you apply and you get denied, don't worry because I see the approvals, I see the denials. If it's denied, we're going to find another option for you. Okay. If you're looking to buy a rental property, that is a DSCR loan. If you're looking to buy a property that has holes in the wall, it's boarded up, like it needs a lot of renovation, that is a fix and flip loan. Okay. Now, if you want to buy a rental property and it needs work, right? But your plan is to rent it out, then you're going to use that BRRRR strategy. You're going to buy the property with a renovation loan or a fix and flip, and then you're going to rent it out, refinance it, and repeat the process, right? That's that BRRRR strategy. You need to close fast. You say, Danielle, I have a deal. It's got to close in a week. This is going into foreclosure. That's going to be a bridge or hard money. You want 5 units or more, it's commercial or warehouse or whatever. If you are looking to buy a business for yourself, that's going to be your 7A or 504B. If you're looking to finance a bunch of properties, whether it's a purchase or a refinance, we can do that blanket loan. If you want to buy and sell real estate in an IRA, that is your self-directed IRA, and you need a non-recourse loan for that. Okay. If you want to combine your first mortgage with a HELOC and a checking account, that is the all-in-one loan. Go to YouTube, Danielle Damianov, and check it out. You can see all the tutorials that I have on there on how to do it. So one thing I want you guys to think about is like the cheapest loan is not always going to be the best loan for you. You need to think of your strategy. You need to ask yourself, first of all, what is my capital and what is my cash flow? How much cash do I need at closing? If you have $70,000, but you want to buy multiple properties, well, maybe don't put all $70,000 in one property, right? Maybe we're going to look at spreading that out. You want to see what your monthly cash flow is, what is left after closing, because you do not want to deplete everything that you have. Then you want to look at what is the total cost. Remember, when we're talking about down payment, we're not mentioning closing costs. So these types of loans, they're riskier loans. They're not looking at income. There are higher costs with them. Most of them are going to have a prepayment penalty, not the fix and flips, not the bridge loans, not the short-term loans, but the DSCR loan. If you want a good interest rate, a 7.125, I just priced another one today, 7.125, 80% loan to value, long-term rent, 2-year prepay, 800 credit score. Okay. So the rates are better when we had the prepay. That same rate would be probably 8% or a little bit over if there was no prepay. So can I refinance when the conditions improve or the market improves? And then really looking at what your strategy is, how fast you need to close and things like that. Okay. So real estate agents, you guys are the key here. And I say you guys, yes, I do have my real estate. I have my broker associate license, but I don't sell real estate, right? So if you guys are looking for more deals, you're looking for more listings, look at the expired listings in the properties that need work, because the agents that did not attend this webinar, that do not know anything about these types of loans that I just shared with you guys, guess what? They're listing a lot of these properties as cash only, which is limiting their buyer pool. Not everyone has $300,000-$400,000 plus renovation, right? So they're listing them as cash only, which is lowering their buyer pool, and these properties are expiring off the market. This is when you come in and say, hey, I saw your property expired off the market. I saw some inconsistencies with the listing that I'd love to share with you. Do you have time to meet with me Friday at 2:00 for about 15 minutes to see how I can help you get your property sold? You know, whatever you want to say, think of your little pitch. But anyways, that is so important. You're going to have better conversations the more you know about financing. And seriously, with your clients, if you want to hop on a call and do a strategy call, that is what I am here for. So the questions that you should be asking, every investor should be asking themselves, and every real estate agent should be asking those investors is, number one, what is your strategy? Like what is your long-term goal with the property? Okay. How much cash do you have? Right? We looked at a loan the other day and we were looking at the bank statements and we're like, wait, there's not enough money for what the guy's trying to do. And then we realized, oh, he actually does have more money, right? So really having those conversations with, well, how much actual cash do you have to not only put down, but closing costs plus reserves afterwards? Do you have any equity in your current home that you would be willing to take a home equity line of credit out to be able to use? How quickly do you need the funds? If you need the funds in a week and a half, you're not getting a DSCR loan, right? You're getting a hard money loan and you're flipping that into a DSCR loan. So sometimes we have to use these loans, they go hand in hand. Do you want to put it in your personal name, or do you want to put it in an LLC? Some people would think, well, I don't even know how to create an LLC, right? So that's where you as a real estate agent can say, hey, all you got to do is go online and it's easy. ChatGPT can create an operating agreement in 2 minutes. And then what is your exit strategy? So you really want to also, this is so important, And this is why I love working with real estate investors. If you work with a home buyer, they are so emotional. Oh, the kitchen and this and the that. You guys need to fall in love with the numbers, not the property, not the potential that the property can have, the actual numbers on the property. Does it make sense? Analyze the deal. In a declining market, reduct what you think you're going to make, take 10% off. I think the after repair value is going to be $400,000. Reduce that by 5 or 10%. Does the numbers still work? Right? Because some markets are declining. How much financing can I, let's say I have a vacancy in the property and it's $2,000 a month for my mortgage. Can I actually make those payments? If there's, whatever, the tenants leave and they don't pay or blah, 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 right? So you want to make sure that you're analyzing all of that and you know your strategy. Okay. So if you are looking to build your financing strategy, if you scan this QR code, that is my booking link. And also, if you guys scroll up in the chat, you'll see all of the other links that I put in there. I am going to add the custom GPT deal analyzer. Actually, let me see. I hope I have it. Oh, Jeff, that's awesome. I need to hear more about that. Okay, so scan the QR code if you want to have a strategy session with me. Okay. On whatever it is you're trying to do. You're a real estate agent. You want to talk about how you can work with more real estate investors. You're a real estate investor. You want to talk about how you can invest in real estate. You're a loan officer and you want to talk about whatever, I don't care. Book a 15-minute call with me, use that QR code. And then also do not forget, I just realized, I don't think, oh wait, is it here? Let me see. Okay. So this is the deal analyzer that I am putting here in the chat. So that way, scroll back down. What is it that you need, Brandy, so I can get it to you? So do you need this or do you need the links that were, because it looks like, are the links gone? Should I put the links back in there? Do you guys need the links? So the QR code, you can book a call with me. That GPT I created specifically for real estate investments. Okay. So how that works is you can analyze when you click on that, make sure you have your chat GPT open. Okay. When you click on that, it is going to then put that into your chat GPT as one of your GPTs. When you have a deal, you can go to that GPT and it is going to ask you questions and it is going to analyze that deal for you. Now, do not use that to replace your trusted source, which would be a real estate agent or a lender. Okay. Do not use that GPT to replace. But if you are there at 1 a.m. in the morning because you can't sleep and you're looking on Zillow and you're like, this looks like a good investment property, go on over to that real estate investment deal analyzer, okay, and plug in the numbers and work with it to see if that is a deal that you want to bring to your real estate agent or whoever it is that you're working with or your lender to see if it works, okay? So all of the links, and I'll put the links again in the chat here. Actually, I'll just put this one. This has all of my information, okay? So this has and I'll show you real quick. If you guys want to book that 15-minute call with me right here, this is also going to be on YouTube. So if you guys follow me on YouTube, my channel is Real Estate Secrets Unlocked. I am looking to grow my YouTube right now, so please subscribe to my YouTube. It's called Real Estate Secrets Unlocked. If you want more information on Next to Lending or Axon Realty, it's going to be on this link here. Also, partner with me at Next and Axon. I highly encourage you, if you are still on this call and you are a real estate agent, or you are a loan officer, to schedule a 15-minute call with me to see if going to Michigan on that 2-day event where we pay for everything to show you what we got going on, or you're a realtor and you want to make money on mortgage referrals. I can show you how to do that. And there's a video on it at partnerwithme@nexalending.com. Also, if you want to apply for a mortgage, that's there as well. So all of those are in my links, or all of those are on one page that I just dropped in the chat. So does anybody have any questions, comments, anything that they want to ask me before we hop off? Thank you guys for being here. I know that it is Thursday. I normally do all my lunch and learns Thursday at 12, so you can bring your lunch and learn. But thank you, Kai. You're awesome. Thank you for coming. And there will be, like I said, there will be a replay on this. I will send it out to you. Thank you, Ray. So if you guys want to share this with anybody, you can. And that's it. Make sure you get that deal analyzer, and then I will send the bonuses in an email as well. Okay. So have a great rest of your day, everybody. Thank you guys for coming, and we'll get that replay out to you within 24 hours. Alrighty. Bye.